Hello, and thanks for joining me today. Before we dive in, I want to set the stage with a simple idea. The home equity market for seniors has never been bigger, and yet most retirement plans still treat the house as an afterthought. So, my goal over the next few minutes is to make the case that a truly holistic plan brings the home into the conversation right alongside the portfolio. I'm Bruce Klein with Gulf Coast Reverse Mortgage, and I focus exclusively on how home equity fits into retirement planning. So let's get into it. Let's start with a few numbers because I think they tell the story better than I can, frankly. So 44% of homeowners between 60 and 70 are still carrying a mortgage into retirement. And 70% of those folks say they may never pay it off. On top of that, 76% of Americans now say they plan to delay retirement, mostly because they're worried their savings won't stretch far enough. Then there's long-term care. Only 7% of people have insurance for it, but about 70% of us will need some kind of care eventually. And here's the number that ties it all together. Homeowners 62 and older are sitting on more than $14 trillion in home equity. Most of that is never factored into the plan at all. So why isn't home equity part of more plans already? Honestly, it comes down to how our industry used to talk about it. The old view treated a reverse mortgage as a last resort, something you only reach for, once your savings were already gone. And it was viewed as debt, as a liability to eliminate, pay it off. And it usually showed up during a crisis. But the new approach flips all of that. So today, forward thinking planners are opening a line of credit early on purpose, treating it as an asset that adds flexibility and building it in ahead of time as a buffer, not a reaction to one. Now, if you're picturing the reverse mortgages from 20 years ago, I know you're throwing up the X. Oh, gross, get it out of here. I don't want to talk about it. It's horrible. I'll never discuss it with my client. I want to update that picture because the program has changed a lot. I promise you, I would not be here talking about it if I didn't believe that it was a great program for the right client. Not for everyone, for the right client. The consumer protections used to be pretty thin on these programs, with real room for costly surprises for the homeowner. But today, every borrower goes through mandatory HUD counseling, a financial assessment, and required set asides to protect them. Spousal protection is a big one too. It used to be that a non borrowing spouse could actually lose the home. Now, that spouse can stay in the home for life. And payout options have expanded from basically just a lump sum to a lump sum, monthly income, a line of credit, or a mix of any of the three. So honestly, financial planning has been through a shift like this before. If you think about it, when the Roth IRA showed up, there were some changes. There was a shift. It changed the order of operations for how everyone thought about withdrawals. I'd argue home equity is going through that same kind of moment right now. Let's cover the basics quickly, okay? Because I don't want to spend all our time on mechanics. We can go over this and I can answer your questions, outside of this presentation. But first, there is no required monthly payment on a reverse mortgage. Your client can make payments if they want to, but they never have to. They just need to keep up with property taxes and insurance. Second, it's a non-recourse loan, which means your client or their heirs will never owe more than the home is worth, no matter what happens to home values. Listen to me, never owe more than the home is worth. What if they owe 1.5 million and the value of the home is 1 million? They will never owe more than the appraised value of the home at that time. Third, it's FHA insured. And that backing is exactly what funds the protections. The counseling requirement is also part of that. And the growing line of credit that I'll be showing you in just a few minutes. And fourth, there's real flexibility in how the funds come out. The lump sum, monthly income, line of credit, or a combination of the three, whatever fits the plan for that client. I also want to introduce you to someone who's done a lot of the heavy lifting here. If you're not familiar with him already, his name is Wade Pfau. He holds a PhD in economics and is one of the leading retirement income researchers in the country. He literally wrote the book on this called Reverse Mortgages, How to Use Reverse Mortgages to Secure Your Retirement. He's a leading voice in the safety first school of retirement planning, and his research is a big part of why the industry narrative has shifted from viewing reverse mortgages as a crisis tool to seeing them as proactive, integrated, integrated piece of the portfolio strategy. One of the problems with Faust's research really digs into one of the problems his research that it really digs into is called sequence of returns risk. And if you're not deep into retirement income planning day to day, this is worth slowing down for. Here's the core idea. A market downturn early in retirement combined with regular withdrawals can do lasting damage to a portfolio. And here's the tricky part. It's not reversible. Even once markets bounce back, if that portfolio, if a portfolio that's been drawn down too far, often can't fully catch back up. So during those drawdown years, the order the returns happen in can actually matter more than the average return itself. That's what makes this a hidden risk. And it's one of the trickiest things for a planner to manage for a client relying on that portfolio for income. I'm sure you can agree with that. So here's where the HECM line of credit comes in as a real solution to that problem. In a portfolio only approach, a market downturn forces liquidation of assets at exactly the wrong time, which creates permanent capital impairment because you're selling low. That reduces the long-term sustainability of the whole portfolio, and there's no offsetting source of liquidity that when markets drop. Compare that to a portfolio plus standby credit strategy. Compare it to a portfolio plus standby credit strategy. You proactively set up HECM, a reverse mortgage line of credit ahead of time. That credit compounds and grows independent of what the market is doing. When volatility hits, you draw from the line instead of the portfolio, which means faster recovery and greater long-term sustainability. Just to make this concrete, a 62-year-old with 600,000 with a $600,000 home might open a line of credit around 214,000. Left untouched, if he doesn't touch that 214,000, that line can keep growing well beyond the original amount over time. That's a hypothetical, of course. The actual growth may vary, but you take a $214,000 line of credit and it's going to grow at the interest rate that the loan is taken out on. Right now, at the time of this particular presentation, it's about 6.5%. So 214,000 growing at 6.5% a year, you know, do the math. That's a good return. For a lot of folks who are maybe cash strapped and you've got to pay your property taxes and insurance, you don't have a mortgage, and you're coming up with $8,000, $10,000, that can be hard on seniors. So They can use this strategy just simply to take that money every year from that line of credit, the profit, it's tax free, and then use that to pay taxes and insurance. That's a strategy that many are using. Or leave it alone and it just grows, compounds year over year. So, where does home equity actually fit into a plan? I'd encourage you to run any conversation about it through 4 questions. First, cash flow. Does this help your client cover expenses without running down savings faster than they should? Second, liquidity. Is there a cushion in place for the unexpected without having to sell investments at the wrong time? Without having to sell the investments at the wrong time. Third, tax coordination. Can drawing from home equity in a given year lower a client's taxable income or even support a Roth conversion? And fourth, legacy. What does the family actually want to leave behind? And how does that shape whether and how home equity gets used? Oftentimes, the heirs don't want the home. Maybe they've had that home 30 or 40 years. They don't want the home. And a lot of times, maybe they'd rather the their parents enjoy the latter years of their life versus sitting on top of that mountain of equity and not being able to access it. Just knowing that it's paid off and my heirs are going to get it. It's worth having a conversation. So I want to be really clear about something here, though. This is not a standalone product, and it's not meant to replace the relationship you already have with your client. Absolutely not. It's one more lever within the broader retirement income plan. The real value comes from synchronizing the reverse mortgage with Social Security timing, portfolio withdrawal sequencing, and tax planning. All the things you're already coordinating. And on roles, you continue to lead the primary client relationship in the overall strategy. I handle the loan origination and the technical reverse mortgage mechanics. You stay the trusted advisor. I'm just here to help make one more tool work for your client. And one more note on this. We have a specialized reverse mortgage team. That's all they do. We have people on that team that are seniors who have reverse mortgages, and they are part of the conversation. They will answer a lot of those questions that our seniors are going to have about the program. So it's really a full team approach that we take in our reverse mortgage division. Just know that we're going to take special care of your client. If you bring someone to us, we know how special that client is to you, and we're going to treat them well and help them understand everything about the product before they ever make a decision to move forward with a reverse mortgage. So let's talk about what this actually looks like with just a simple example. So picture a couple in their mid 60s with a $500,000 primary residence. The very start of retirement, they establish a home equity line of credit, a reverse mortgage line of credit, creating a financial safety net before they need it. From there, the unused portion of that line keeps growing over time, independent of market fluctuations. Independent of market fluctuations. So their available liquidity actually increases the longer they wait. Then, when markets pull back, instead of selling investments at a loss, they can draw from that line to cover living expenses, which gives their portfolio time to recover. Over 10 years, that growing line can provide a real cushion through market volatility without ever requiring them to liquidate their investments. Again, this is a hypothetical scenario just to illustrate the mechanism and how it may work for one of your clients. Beyond that standby line of credit, there are a handful of other strategies worth keeping in your back pocket. Some clients use reverse mortgage funds to cover the tax bill, as I mentioned earlier, tax bill on a Roth conversion instead of pulling that money from savings. Okay, they're either their property tax bill or the tax bill on the Roth conversion, instead of take that money out of their savings account. Others use it to bridge the gap while they delay Social Security. Since delaying grows the lifetime benefit and the home equity credit, the reverse mortgage can help cover income in the meantime. It can also pay off high interest debt. Credit card balances at 20%, 27% or more are a real drag in retirement. And home equity can clear that out with no required payment. And finally, some clients use it to buy their next home. That's called a reverse mortgage for purchase. And honestly, it deserves its own conversation entirely. And I've got a separate session just on that. So if you're curious about the the reverse mortgage for purchase, just let me know, ask about it, and we can schedule a time to go over that. So where do I fit in all this? I'm an independent broker serving really all of Texas. I'm located in Galveston County, Crystal Beach. I work a lot with folks in Galveston and the Crystal Beach area, the Bolivar Peninsula, all over Galveston County, but throughout Texas. If you have clients here, and I'm also licensed in Florida and California. So my team works exclusively, as I mentioned, in reverse mortgages through our dedicated NEXA lending reverse division. So this isn't a side product for me. It's a huge focus. Yes, I do forward mortgage as well, but with this dedicated team of reverse mortgage, it gets the full attention for your client who comes to me with a reverse. So when we partner, there's no cost to your firm. Of course not. And I will provide expert meeting support and white label client service. All right. I am here to take care of all the paperwork and the numbers behind the scenes. You stay their trusted advisor the entire time. I'm here to provide one piece of that. And again, if you're going to trust me with your clients, know that we're going to take excellent care of them. So how can we actually work together? There are a few pathways. We can co-present seminars together, where I partner with you to host educational sessions that give real value to your client base, maybe attract new clients into your client base. I can also provide a complimentary reverse mortgage feasibility analysis. It's a no-cost expert evaluation of a client's reverse mortgage potential to support their retirement plan. Of course, I'll keep you in the loop um, with ongoing market intelligence, regular insights, and updates on home equity products. And when it's time for a referral, the handoff is simple and transparent. You stay fully involved throughout the entire client journey. You can be as involved as you want to be or as hands off as you want to be. We can do this together. It's built around transparency and putting your client first. So here's what I love to do next. Let's find 15 minutes this month to sit down and run through one client scenario together. No pressure, just a chance to see how this might actually apply to somebody in your book of business. So you can reach me easily here at my number. This is my cell number. Call or text me anytime at 214-729-2947 or email me at my first initial B, Klein, C-L-I-N-E, at nexalending.com. You can also find more at gulfcoastreverse.com, and you or your client can schedule a consultation with me at consultwithbruce.com. Listen, thanks again for spending the time to watch this with me today. I love to keep the conversation going, so let me know a good time. Hop on that Consult with Bruce and let's get it scheduled. And let's talk about how this may be a valuable tool that you can add for your clients to keep them from having to mess with any of the assets that you're managing for them. And they're sitting on top, many of them are sitting on a huge asset that remains untapped. A lot of them cannot do a cash out refinance. They can't qualify because Social Security payment's not enough. This is a way they can tap into that equity. They can do a line of credit one of my favorite things about this product is that line of credit that grows over time, tax-free over time. So look forward to speaking with you. You've got my information now, and I will talk to you soon. Thanks again for watching. Have a good one.